What's up? It's Rowan here from Artist Smart Education with the weekly HSC Economic Stats Update. In this episode, I'm going to be unpacking some data on whether or not the Stage 3 tax cuts are actually having some inflationary impact. We've got a couple of months of data now so we can make an evaluation on this, which will help you in your analysis of the effectiveness of fiscal policy and this year's federal budget in achieving its economic objectives, in particular dealing with the conflict of objectives and considering the macro policy mix. We're also going to be looking at consumer confidence, what it's doing right now, how that plays into the overall economic growth conditions of the Australian economy. And then finally, we're going to be looking at Chinese economy, the impact on its slowing down on Australia, particularly with some amazing data that you can use on evaluating the impact that the iron ore price and the changes in that have on the Australian economy and the budget. So let's dive right in now. If this is the first time that you've watched this, in minutes I summarise the key stats and headlines from around the domestic and global economy, giving you the key insights you need to unlock a Band 6 in the HSC Economics course. So, we're now 2 months in with the Stage 3 tax cuts, which were a key feature of the recent federal budget. Now, note these are worth about $5 billion in July and August. So think of that as, $5 billion of extra money floating around the economy that in theory should go through to increased consumption, right? Increased income, right, will obviously be spent depending on our marginal propensity to save or consume. But the idea would be that typically as we get more income, an element of it's going to be consumed, driving increased expenditure. And that was therefore what the risk was on the current budget in terms of would it create some demand pull inflationary pressures through consumption. Now, what we're seeing from the data that both Commonwealth and Westpac banks have when they track spending through credit and debit card networks, basically is right now showing barely any change in consumer expenditure since the cuts kicked in. So that's actually some positive news because on the one hand, what it's saying is, well, look, all of that criticism around the budget saying that, it's going to be inflationary and it's at odds with the monetary policy sort of setting of trying to really reduce inflationary pressure here. It's going to actually continue to make it sticky. That doesn't look like it's happened. So you can use this in your analysis to highlight what good news for the budget, right? The good news for the budget is that its tax cuts don't appear to end up having an inflationary impact. Now, there's some bad news though, right? Because equally at the same time, economic growth is pretty anemic. It's 0.2. It's, for the quarter, it's 1.5%. That's the lowest it's been, excluding COVID, since 91-92. That's 30 years ago when we were coming out of a recession. So we've got some of the worst economic growth we've had in a long time. And so really, if monetary policy is like clamping down on the economy and being very contractionary to drive downward pressure on inflation, you need the budget, therefore, to be the thing that is somehow managing to walk a really fine line in that conflict between economic growth and inflation, right? To somehow support that economic growth in a way that doesn't produce inflation, but supports it so that the economy stays in positive growth and doesn't enter into a recession. And that's really what we're needing our macro policy mix to do right now. Now, the challenge, though, is if it's not being spent and it's not driving increases in consumption, it's therefore not having an impact on the economy in the way that we would maybe like it to. So I think the key is, at one level, you don't want it to be inflationary, but you do want it, given economic growth is so anemic, it's just flirting above, the recession, you do want fiscal policy to play some role in continuing to support economic growth. It appears, right, that if it's not doing that through consumption, which is what the tax cuts you'd expect would do, then the budget may not be having the desired impact that it would like. And so there is a little bit of, some nuance in the argument that you could take here in evaluating the effectiveness of policy. Now, we can see this a little bit further if we go and take a look at, the data from ANZ Roy Morgan's consumer confidence. And we can see here, right, that ultimately it's down, a little bit, right? Ultimately, though, it's now at 84 straight weeks above the mark of 85. So if we think about that, it's, a year and 3 quarters almost, it's been pretty low, below 85, right? Now, the thing to highlight is it is a little ahead of last year. So it's 4.7 points above the same time last year, okay? And it's, pretty identical to the weekly average. So in other words, it's not really shifting all that much, right? If it's pretty much the same as the weekly average, it's only a little bit ahead of last year, right? What that shows is that maybe the budget hasn't had really much of an impact then on driving consumer confidence and therefore a little bit more spending and really trying to support economic growth. Now, of course, monetary policy still remain contractionary. That's always going to play a role in really softening, consumer confidence. And you could argue that, a slowing Chinese economy, US economy, that news filtering through is also going to play a role. But that's exactly where the budget and its expenditure items are designed to, in theory here, drive some greater confidence, particularly given this budget was very much one of, cost of living relief. Like, let's make sure that we're putting, needed money into, the hands of households that are struggling right now. And we can see that it doesn't appear that it's really had that impact. Like, it might have had like a little bump, but given that we're back to the weekly average of this year, it shows that it hasn't really had a bit of a sustained impact there. And we can see that, we look at current financial conditions, a fifth of Australians, right? 23% say their families are better off financially this time versus last year. So that's good, but note that hasn't changed, right? That's staying pretty similar, right? And then 47% are saying their families are worse off. That's down a little bit, it's 3 points. So my point we can see by looking at this data is that the consumer confidence is so similar, it hasn't really shifted enough. And so you could argue, well, that's one of the limitations in part of the budget is that, it's the thing that needs to be driving economic growth in the economy right now, given the contractionary monetary policy settings that we're seeing. And it's arguably not doing that to the degree that it probably needs to. Now, of course, fine line that it's walking, right? The conflict of objectives, it's obviously a really pertinent part of the economics course and so much, in this year, in this context, between inflation and economic growth. And so the budget obviously needs to walk that tightrope. And, so the argument that you could have here is maybe it's not getting it quite right because we're not seeing enough of a bump. Now, the final thing I want to really highlight is, some more data that's emerging around the Chinese economy and its impact for Australia. And this is really, really powerful stuff. So, the first thing to highlight here is, that the Chinese economy is, going through a slowdown. A lot of that is due to the sort of property market collapse that's happening. And that then has flow-on effects, right? It has flow-on effects for, steel production in the Chinese economy, which in turn has flow-on effects for Australia for, Chinese demand for commodities. Now, historically, China and the relationship with China has been very, very important in, basically, enabling us to maintain strong economic growth. We saw that during the GFC. Arguably we've really seen that as well during the COVID period. Certainly the tail end of secular stagnation, 2018, 2019, and then going into the COVID period as well, that Chinese demand has remained very strong. And certainly over the last couple of years, that's played such a critical role in helping us achieve the first two surplus budgets, right? That Australia has really achieved since 2006, 2007. We can see that here, right? Like bumper prices played a big role in helping us deliver these surpluses. So that's bumper prices for our commodities, and particularly iron ore, off the back of Chinese demand. So they've played a really critical role for us. Now, the challenge is with the Chinese economy slowing, that's going to mean that, this commodity prices are going to be shrinking as well as export revenues. Now, note, exports over the last couple of years have played a critical role in supporting economic growth. Often, when domestic consumption and investment and other areas of the economy have not been performing, exports have been the thing that's been contributing to our growth. Given we're at such anemic growth already, this does not bode well there for the Australian economy, and maybe the thing that is, tips us into, that negative growth and possibly, if we do 2 quarters, of recession. Now, we can see, yes, on the one hand, there's some good positives here, right? There's a progressive removal of punitive tariffs that China imposed in 2020, and that's on about 20 billion of our exports. And so the hope is, okay, great, we're going to see some benefit from that. But that all is still based on the assumption that Chinese consumption picks up and it's remaining quite flat. Now, ultimately, there is a commodity price index with China, and that's now 5% lower than a year ago, and staggeringly 35% lower than 2 years ago. So if we zoom out and we see that in its full context, we can see, wow, it's a lot lower than it was. Now, the challenge here for Australia is that iron ore, Australia's biggest export, has now dropped below $90 a ton. Okay, it's the lowest level in almost 2 years. Okay, so it's certainly showing a downward trend. Now, the impact of this is the thing that we've got to appreciate, and the key thing to make it into your analysis, right, is that every $10 decrease in the iron ore price lops $500 million off the budget. So we're going to see, just as a result of this, that as we continue to see, the iron ore price remain low and have deflationary pressure on, it's going to place budget pressures on the government, okay, simply around like their earnings in terms of their revenue. Equally on the flip side, okay, we can see that it removes $5.3 billion from Australia's economic growth, which, as we've highlighted, is already very, very anemic. So there we have it. Okay, I think some key stats that you can certainly utilize, potentially looking at, the role that the global economy is playing on Australia, certainly the Chinese economy. And this is one of the big limitations around our government policy and what we're currently doing right now, which is the extent to which, we're still very reliant on our relationship with our major trading partners for economic growth, and how that may play a role in actually causing us to fall in economic growth, and therefore impact the effectiveness of our current macro policy mix.